So let me tell you what is the income statement. The income statement measures the operating performance of the company to get profits. And here on my side is the basic structure or the basic equation of the income statement. So at the top of the line we have sales or revenue, which basically is how much money is getting into you after all your sales. And at the bottom line, we have the net income after all your expenses. And here in the expenses, it's where it actually gets complicated, because we have different type of expenses, like salaries, like suppliers or services, fixed costs, variable costs, direct and indirect costs that measures that operating performance of the company to get all the profits. So this is the basic equation. Now let's move on so I can explain deeply all the items contained in the income statement. I want to talk first about the top line of the income statement. Sales or revenue is basically all the money that is getting into your company after all services and products sold. And this is one of the most important numbers on the income statement. It will be used for forecasting, budgeting, and even analyzing the company. That's why we have to be in close communication and get accurate information from the sales department. Key things like the market research, conversion rate of the sales strategy, and even economical figures will help us to get this number accurately. I also want to tell you something about inflation. All the companies change their prices every year according to the inflation rates. This is a very important thing so we don't lose the value of the money over time. Take into consideration when analyzing all the inflation rates. I want to mention as well that sales or revenue is key to obtain the rest of the income statement. Basically, the rest of the items of the income statement depend on this number on sales. And they are basically a percentage of sales, and they will be connected all the time throughout the income statement. So make sure that the number and the quantity you have on sales or revenue is accurate. Otherwise, it will affect the whole income statement. The income statement, it's a great tool to take managerial decisions of the company and take control of the cost and expenses. That's why I believe it's important that before I continue, I explain you key concepts that will help you to analyze just better the income statement. I want to explain the difference between variable and fixed costs. Variable costs are all those costs incurred by the company and that are directly linked to the activity level of the company. For example, the raw materials. If sales increase, we have more activity, so we have to purchase more raw materials. And now, the fixed costs are not directly linked with the activity level of the company. One example could be rent. For example, if sales increase, we will pay the same amount of rent. This value will not change. When it comes to calculate costs, we have two types: direct costs and indirect costs. Direct costs are all those that can be easily traced and be assigned to a product or service, and they don't need a subjective distribution criteria to be assigned to a certain product or service. A typical example would be the components of a product and the direct labor. Think about an assembly line. All the people that are working in the assembly line are the direct labor managing all the products or components that they have to be in the final product. Indirect costs cannot be easily traced and be allocated to a product or service, so we need to invent a subjective distribution criteria to allocate the indirect costs to a final finished product or service. This is a difficult task. Let me give you an example. In an overhead factory, everyone uses electricity, But if you want to know how much electricity uses certain products, you need to subjectively think of an idea so that you can allocate that electricity to the product. For example, putting a device that measures all the electricity used in that certain area. Now, to understand all the costs incurred by the company, we have to be very detailed in the accounting. For that, we need to know the difference between a cost, an expense, and a payment. A cost is the value of the consumption of inputs to produce outputs. As a chef buys food, which is the inputs, to produce the final product, which is the dish, and this will be the output. Now, if we talk about expenses, and normally things considered expenses are regulated by the government. And payment, it's a treasury transaction. It's basically money out of your company. For example, when you pay to suppliers, that's a treasury transaction, a payment. But this could be combined. For example, we have costs that are not considered expenses, like the cost of opportunity, or we have costs that are expenses as well, like the amortization. And not all expenses that are costs are also paid. And we will use the same example. The amortization, it's something that it costs you, but you are not paying it actually. It's written down in the expenses, but it's not a cash out. Now that I explained all these concepts, you're ready to move on to the second part of the income statement, which is the cost of goods sold, also called cost of sales or just COGS. COGS are the direct variable allocated costs the company incurred when purchased and converted materials into finished products and services sold to customers. So let me give you an example. Imagine you have a store and launch a new brand of clothes. In this case, your core business is selling clothes to women. So your cost of goods sold is the inventory you have and the direct labor. Because before having that finished product on display, you need to buy the fabric and pay the people that design the clothes. About sales and cost of goods sold, let's move to gross margin. And this is already a result. Gross margin is obtained by the difference between sales and cost of goods sold. So sale minus cost of goods sold, it's equal to gross margin. Gross margin tells us how profitable the company's operations are. Higher margins are more desirable to companies. And if you have a high margin, you already have an advantage over your competitors. And this is why companies are so interested in innovation, because it gets you higher margins. You can innovate in your products, you can innovate in your supply chain, or even by being more creative and offering a better service. So if your margin decreases, it's because a few reasons. It's because you got more cheaper, that means you're selling at a lower price to your customers, or your labor and raw material got more expensive. That's why you already have to keep an eye on your COGS. That means on your cost of goods sold. Now that you have understand the gross margin, which is the difference between sales and COGS, let's move to operating expenses, or just OPEX. Operating expenses are the fixed allocated costs the company incurred when was operating to get revenues. This is an ongoing cost just for running your business. And here we can find the marketing expenses, for example, the administrative expenses, salaries, and general expenses. Let me tell you a few things about operating expenses. These are the fixed costs of the company, and typically they are indirect costs, meaning that they don't have an objective criteria to allocate these costs to a product or a project or a service sold to customers. It's an indirect cost. And finally, you have to keep them as low as possible all the years. because with fluctuating sales, this will really damage your profits.